Hello and welcome to Gold and Silver Assets. It's Sunday the 26th of April 2020. So a few of our viewers have been asking about whether it's better to buy gold or silver at this time. Now this isn't a one-size-fits-all answer to this question, as everyone has individual circumstances and risk tolerances. So today I'm going to use the charts to illustrate a few of the factors to consider, particularly looking at the gold-silver ratio and how this may be used to your benefit. One of these things includes how to buy a house for $31,000. Now this isn't bait, and I'm actually going to discuss a strategy that has been successful in the past. But it will take a little bit of explanation, so just bear with me. We'll start by looking at this chart, which compares gold and silver in US dollars on the monthly scale, and each of these is expressed as a percentage change. So I'll start by saying that precious metals is a very emotive subject, and it's very common for heated debates to occur within the community itself. And silver seems to stir up a particular amount of high emotions, almost in a bipolar way. And one of the reasons for this is actually demonstrated in this chart. During a bull market, both gold and silver initially go up together, and as the bull market progresses, silver outperforms gold, as we saw over here. And that's where the emotions of euphoria come in. However, when prices drop, they drop hard, and the declines are usually worse than we see in the gold price. And this elicits emotions of bitterness and frustration, particularly from those who bought at these kinds of levels by FOMOing in and buying into the euphoria. Now, currently, although gold is actually doing pretty well and coming close to its previous peaks, silver is nowhere near its previous peak. In fact, it's currently at levels that were seen back in 2008, 2009 kind of time. And so I think it's fair to say that people are pretty much fed up of silver. And I would almost go as far as to say that a lot of people have actually lost hope. And those are emotions that are often quite seen at market bottoms. So we can see from this chart that silver has a much greater volatility than gold, and it's more prone to having these bubbles and crashes. And that is one of the factors that should inform your decision about whether to buy gold or silver. So it really depends on your tolerance for risk. Moving on to the gold-silver ratio. And this is the chart on the monthly scale, and this is shown in the bars, and for comparison I've also drawn in blue the gold price in US dollars. And we know that currently the gold-silver ratio is at historically high levels. I've had some viewers ask whether this is of any relevance. Does it actually mean anything? If we look at it in comparison to the gold price, one way of looking at these things is to look at the correlation coefficient. And again, the correlations just seem to go up and down. There's not really much to see here. However, if we compare the ratio to the silver price, which is shown in blue here, then we can see a much stronger pattern emerging when we look at the correlation coefficient. So we can see that for the majority of the time, the gold-silver ratio is strongly negatively correlated to the silver price. So what that basically means is that when the silver prices go up, the gold-silver ratio goes down. Another interesting thing to note is that whenever the gold-silver ratio has peaked above the 80 level, then silver price is actually at relative low points, as shown here. And the other thing of interest is that before we hit those lows, the correlation coefficient has turned positive. And right now we've just come off a positive level again. And every time we've come off of these points, prices have risen to varying levels. Note that at this peak in gold-silver ratio, we never actually hit those positive levels here, and of course prices didn't rise as much as we had seen previously. So if this pattern is correct, then this would suggest that we are currently at a relative low in terms of the silver price, suggesting a possible strong up move. And given all these years of grinding prices and frustration, I think most of the speculators would have been flushed out, and given the very low sentiment, that's usually a very bullish sign. So let's look at the 100-year chart of the gold and silver ratio, and we can see the major peaks here, and of course today's values. And in the past, these major peaks have occurred at times of turmoil, which is a bit worrying considering we're now at historic highs. So the thing to note from this chart is that the gold-silver ratio doesn't spend very long at these kind of levels. It tends to spike rather than remain sustained at high levels. And most of the time, the gold-silver ratio is kind of spent at around the maybe 70 to 50 level, certainly in the past few decades. And people have used this observation to profit from it. And this involves a strategy where the person would buy silver when the gold-silver ratio is high, and then as the ratio drops, they would swap their silver for gold. So, for example, if you were to buy silver when the gold-silver ratio is at 100 and then wait for the ratio to drop to 50, then you would have twice as much gold as if you'd just bought gold when the gold-silver ratio was 100. Of course, if the ratio went down to 33, then you would triple the amount of gold. And if it went down to 20, you would have 5 times as much as gold. Now, to me, this does sound like a reasonable strategy. However, there are some other factors that we need to consider here. So, first of all, you would need to be patient, as sometimes it can take years for these things to play out. The other thing is that silver does take up much more room than gold in terms of storage costs and space, and so that would need to be factored in. The other factor, which I think is probably just as important, is the availability of gold. So say you'd bought a whole pile of silver when the gold-silver ratio is high. When it's low, will that much gold be available? Hard to know. But if owning gold is your goal, it would be a risky strategy. And so having everything in silver with the hope of swapping all of it for gold might be a bit of a risk. And so you might want to have a separate portion for taking such risks. There are other ways of using this strategy to your advantage. And one such way is to look at housing. So this chart shows the median US house price in US dollars from 1965 to today. And of course, we can see prices have just continued to rise almost unstoppably, with just some minor blips at times of recession. But remember that this chart doesn't account for loss of purchasing power of the US dollar over time. What if instead we priced houses in terms of gold, as shown by the black line in this chart? We get a very different picture. And just for comparison, I've also included in blue the gold-silver ratio for direct comparison. In 1980, we can see that the gold-silver ratio hit a low of 15. And at that time, you could buy a house for 120 ounces of gold. The other thing to note is that the troughs in the house prices seem to be associated with troughs in the gold-silver ratio prices. And what's happening currently? Well, you need 255 ounces of gold to buy an average house in America. So let's look at the scenario where you decided to buy gold right now, and wait for a trough in the gold-silver ratio, at which point you swap the gold for a house. Well, if we're expecting a trough in the gold-silver ratio similar to 1980, then you would need 120 ounces of gold. And at today's price, let's say gold is $1,727 US. Now, I know that's a spot price and, there's premiums and so on. You can calculate the changes yourself, but this is just for simplicity. So basically, at today's price, you would need to buy $207,240 US worth of gold to buy a house in the future when the gold-silver ratio drops. But what if instead we looked at silver? So this is the average house price in America priced in ounces of silver, shown by the black line, and again the blue line shows the gold-silver ratio. So currently it takes 24,281 ounces of silver to buy an average house in America. Back in 1980, it only took 2,000 ounces of silver to buy an average house. And again, that coincided with that dip in the gold-silver ratio. So if you're expecting a similar dip in the prices back to 1980 levels, then you would need 2,000 ounces of silver. And at today's price, it would cost you $15.20 an ounce of silver. And that gives you a total of $30,400 US. So if you are assuming that we're going to get a large dip in the gold-silver ratio and you want to buy a house using precious metals, then comparing gold and silver, you'd be better off buying silver to purchase that house at a later stage. Now, of course, this makes all kinds of assumptions. We're assuming that the gold-silver ratio will indeed drop to such low levels and that the price of houses, both in precious metal terms or even in fiat terms, are going to drop in the future as well. And the other thing is that we've got no indication at all as to how long it would take, so you would need to be very patient. So I'm not advocating that this is something that's a dead cert, and it's certainly not investment advice. It's just an illustration of one of the many strategies that the gold-silver ratio can be used for. So now we'll move on to looking at our world of ascending wedges that we discussed last week. So an ascending wedge occurs when price action forms this wedge pattern, and what we were expecting was a breakout to the downside followed by a retest and then further moves down. So let's see how these wedges have progressed over the past week. So when we look at the indices, we can see that in the S&P 500, it looks like the price gapped down and broke out to the downside, and it seems to be retesting the lower trend line of that wedge. But all in all, it seems to be holding up reasonably well, certainly considering when we compare it to the Australian stock market, which broke down quite decisively and is just kind of hovering at this level. So this pattern does seem to be working out so far. In terms of the S&P 500, I would say that this pattern would be invalidated if we go above the previous highs. Now remember that we are entering May, and there's that old adage which says sell in May and go away. So May is usually quite horrendous for the stock market. So it'll be interesting to see what happens in the next few weeks. Moving on to gold in US dollars on the daily scale. And gold remains very resilient. So we thought we spotted this up sloping wedge. And again, it looks like it broke down and we're possibly retesting that. So if this is correct, then we would expect a turnaround in the coming days for a further drop. And this channel line may well provide some support. But remember that gold is behaving in a very resilient fashion. And because we're still in a consolidation phase, it's quite difficult to make out what patterns are going on here. Another possibility that people have spoken about is this inverted head and shoulders pattern. But I would say that the neckline is very steep there, and it would be unusual for head and shoulders to be continuation patterns. So I'm a bit skeptical of that, but I would consider that to be a possibility if we go on to make new highs in the coming week above the previous peak. So if we exceed $1,750. If that is the case, then we're heading towards the $1,800 level. Looking at silver in US dollars on the daily scale, it's not behaving quite as strongly as gold is. The wedge that we've drawn remains in play, so again we had a downwards breakout. It's not even really retesting the wedge, so this is looking a bit more like what the Australian stock market was looking at. However, we do seem to have found some support at this very long-standing trend line in red, which I've spoken about in previous videos, and that has the potential to provide support. However, if we break support at $14.80, then I would expect this wedge to be still in play. This wedge would be invalidated if we go above the $16 level. And the GDX on the daily scale has performed outstandingly well. It's managed to break this very long-standing upper channel line, which has been resistance for many years now. The only thing I would say is that these candles up here do look slightly weak, and we do have even more gaps that have formed. And so that does make me a little bit hesitant about where we go from here. To be confident of further up moves, we would want to see the 32 level to behave as support with a bounce off of that. And just a quick look at the GDX priced in gold, and this is drawn on the log scale. So an up move signifies that the miners have outperformed gold to the upside, and we have seen a huge overperformance of the miners relative to gold just in the last few weeks. And so this does add weight to the idea that we are in a bull market for gold, albeit in the early stages. So that's all from me today. All the best, and we'll see you next week. Bye.